Today I'm going to teach you some stuff about how a DEX works, a decentralized exchange. This is going to be a beginner-friendly course. If you're new to crypto, or what I've realized is some people are not new to crypto, but they just never took the time to understand this. And if you understand it, you might learn something and you might be more aware of what's going on in the crypto markets. A decentralized exchange is one of the main innovations in crypto. It's the opposite of a centralized exchange. It's an exchange that's really just a block of code that routes people's trading orders through the code, and you put in token A and you get out token B. Okay, so you can trade any coin for any coin, censorship resistant. No one can tell you what coins you can and can't list, which means people list scams, but really it's just free, open, peer-to-peer trading with no middleman, no centralized exchange company, no leverage. And we're going to learn how they work on the inside and how pumpable certain coins are. So watch the whole thing and pay attention, because this is going to be like a pretty comprehensive class about how DEXs work. And now you can always watch my old videos, but people don't like to do that. All right, people don't like to scroll back. So I'm just going to make a rehash of what I've already said. And if you want more information, there's always my course, Hex Passive Income. But look, some terminology, all right? DEX means decentralized exchange. You're going to hear that word a lot in crypto. AMM stands for automated market maker. It's just the style of, it basically is synonymous with a DEX, okay? Some people sometimes call it a constant product market, and you're going to find out what that means in a couple seconds here. And that's PulseX.com. This is the trading platform on PulseChain. They all kind of look like this. You put in one coin, you get another coin out. So, dollars, USDC coin, let's say I want to buy Hex. You put in $10,000, you get out 2 million Hex. All right? Trading any coin for any coin, they all look like this in their simplest form. And there's not much more to them. And we're going to learn about liquidity and how they work and how the math of it all works. So PulseX is what's called a Uniswap V3 style automated market maker. So Uniswap, this is Uniswap, they invented the concept of DEXs. This is the primary decentralized exchange on Ethereum. And like I said, they all look the same. This is the primary DEX on PulseChain. Ethereum, PulseChain. Ethereum, PulseChain. So Uniswap on Ethereum created the idea of an AMM, or a DEX, or a constant product market. And what that means is that if you want to provide liquidity on a constant product market, you need to put up what's called symmetric liquidity on Uniswap V2. All right, so there's Uniswap V2 and there's Uniswap V3. Uniswap V2 has symmetric liquidity. Uniswap V3 has asymmetric liquidity. We're going to just talk about V2 right now because it makes it easier to understand V3. Uniswap V2, when you provide liquidity in a pool, let's create a liquidity position over here, right? And let's go to V2. And we choose whatever it might be, ETH and USDC. We click continue. You'll notice we put up, if we want to provide liquidity, we have to put up an equal amount on both sides. So $1,000 of USDC, and then it automatically calculates that you're going to need to put up $1,000 of ETH on the other side in this liquidity pair. Now, DEXs have liquidity pairs. That's why I go to DEXscreener.com. DEXscreener.com, if you search, for example, for Hex, it just happens to be my favorite coin. You can search for any coin on here, and you can see all these different pairs. These are all different liquidity pairs, okay? You're bonding one coin to another coin as a liquidity provider, and you're letting other people trade into your liquidity pool. So the innovation here is that, unlike a centralized exchange, on a decentralized exchange, let's say I put up $1,000 of ETH and $1,000 of USDC in the liquidity pool. So I just added $2,000 of liquidity to the pool. Now, because anybody can do this, and there's hundreds or thousands of people across the world doing this, what you end up with is millions and millions of dollars of liquidity. And liquidity is basically the pool of money that other people can trade into or out of. So if I'm just trading on the typical trade exchange tab right here, okay, this is the primary DEX. Most 90% of people, 99% just do this. They trade one coin for another. But how am I able to trade this coin for this coin? Well, somebody on the other side of it all must be putting up the liquidity. They must be bonding two of their own tokens together and taking the other side of the trade. So every time, you want to buy another coin, where does the coin that you want magically come from? It comes from a bunch of people putting up their liquidity, okay, over here. On PulseX, it's right here, the liquidity tab. So on the liquidity tab, if I wanted to add liquidity as a basic concept, let's say I want to put up, $2,300 of PLS. And look how it automatically calculates the equal ratio on the other side. If I put up $2,300 of Pulse, I got to put up $2,300 of PulseX. Because the coins have different USD prices, obviously they're going to be a different number of coins that I have to put up for each side. And I do that on the liquidity side. So most people are just using exchange, but when they're trading coins, their coins are coming from people that are doing this part, the liquidity part. So in order to enter into a liquidity pool, somebody has to be clicking the add liquidity button, connecting their wallet and adding the liquidity button. You'll notice that Uniswap V2 and PulseX are very similar because PulseX is a clone of Uniswap V2. Now, there is V3 and V4. Let's not worry about that right now. Okay, V2. Do you get the concept? So when I'm on DEX Screener and I'm looking at all of these different liquidity pools, these are just people that have bonded different tokens to different tokens. So right here, we've got $1.7 million of Hex and Pulse liquidity, meaning an even 50-50 split. Okay, about 900K on the Hex side, 900K on the Pulse side. Here we've got 208K of Hex bonded to PulseX. So about 104K of Hex and 104K dollars of PulseX. Here we've got on PulseX again, we've got on the V2 pair, we've got 500K of Hex bonded with 500K of Pulse for a total of 1 million. You can go down and add all these up. Another way to see this is on the info page, right on the info page up here where my mouse is. You can always go and find a coin and see the liquidity for it, which we're going to talk about near the end of this video. Okay, near the end. So that sounds pretty basic, but a lot of people still don't understand what liquidity means. Okay, just having coins sitting there, sitting on chain, not actually in a liquidity pool, does not make it liquidity. In order to be liquidity, it needs to be delegated into a pool, and every pool is going to look like another entry on DEX Screener over here, dexscreener.com. Every pool has a pair. All right, look on the side panel, the right panel here. Every coin has an address. Okay, the address always begins with 0x. 0x2b5 for Hex, 0xa10 for Pulse, and then the pair itself has an address as well. Now, I myself also have a crypto address. If I open my MetaMask, this over here is my crypto address. It all begins with 0x. Everything on a blockchain, an EVM chain begins with 0x, and it's a long string of letters and numbers. It just delegates a location, right? They could be a wallet address, like a personal address where I can hold all my money. They can be a coin address. They can be a liquidity pair address. A token address or a contract address, some people call it a CA, is just a place where something happens on a blockchain, a place that stores data and performs functions, right? So an address can define my wallet address where I receive funds. A contract address can define a token itself, meaning all the logic for the token supply and how the token works. A contract address can define a liquidity pair. A contract address could just define a bunch of logic, a bunch of functions. Like you send money into this black box, this address, this contract address. It does some things, it manipulates some numbers, and it spits out an output of something else. So contract addresses just do things. They're just little pieces of code that live on a blockchain that do things. They can be coins, they can be LPs, liquidity pairs, they can be addresses like your personal wallet address, and they can be basically any type of math, any type of code. Just logic and functions. And even, PulseX itself, Uniswap itself, they are also contract addresses. Their contract address router, it's called, is the little block of code that routes all of one coin for another coin. It takes in the user's input. Oh, they want to trade this coin for this coin, and then it finds the ideal route and maximizes how many coins they can get on the output side. So how much bang for their buck they can get. If they're going to put in token A, how much of token B can they get back out? So everything is a contract address in blockchain. Everything. Now we're going to go through this pretty quickly. This is the formula for a symmetric liquidity. And by symmetric, I mean Uniswap V2 or PulseX. PulseX is a clone of Uniswap V2. It looks scary. Do not be scared. I'm going to tell you what all these letters mean, okay? The reserves of token A times the reserves of token B equals K. A constant K. This is why it's called a constant product market. And this is how we're going to calculate the prices of coins and the actual math behind if I trade one coin for another, how can I mathematically predict what the new price of that coin is going to be? So the price of everything in a liquidity pool is just a ratio. For example, if I was the only person in, let's say, the Ethereum USDC liquidity pool, and I put up $1,000 of USDC and let's say 2,000 Ethereum on the other side, what would be the price of Ethereum? Well, it'd be 1,000 divided by 2,000. Okay, it would be 50 cents. I wish Ethereum was 50 cents, but that's how the math works. The price of the token is simply defined by the ratio on the liquidity pool. So The price of the token is defined by the ratio, meaning, again, if I've got $1,000 and 2,000 Ethereum, well, just doing simple algebra, 2,000 ETH, $1,000. $1,000 divided by 2,000 equals zero point 0.5, meaning 1 ETH equals $0.5. 1 ETH equals 50 cents. Simple algebra. Now, when I'm buying a coin, I'm basically depleting the reserves of one side and adding to the reserves of the other side in that liquidity pool. This is going to be an oversimplified example, but this is how it works, okay? So after I make a trade on a DEX, the reserves of token A times the reserves of token B have to continue to equal the constant K, because K means constant. Constant means it doesn't change. Okay. Now I'm going to use dollars and Ethereum as the example here because you think in dollars. You think in dollars. Dollars are the unit of account, right? For life. I mean, you go to the grocery store, bread costs, I don't know, $5. It doesn't cost 0.00001 ETH. That would just be weird. Nobody would understand what that means. Money has to be a store of value, a unit of account, and a medium of exchange. The medium of account, it just means that the way we talk about money, we like to price things in dollars or maybe euro or whatever currency is native to your country. That's going to change eventually. But for now, we price things in dollars. But like, for example, if I had 50 of coin A and 100 of coin B, well, the price of coin A in terms of coin B would just be 100 divided by 50. So 1A would equal 2 of coin B. So basically A equals half as much as B. That's why, you know, Pulse and PulseX, for example, we often talk about the price of Pulse, which I think today is almost a 1-to-1 ratio, but it used to be a 3-to-1 ratio. It used to cost 3 PulseX for every pulse. Now it costs almost 1 PulseX for every pulse. So prices are defined on automated market makers by the ratio of the amount of coins in the pair. And this constant K is going to matter for when we calculate how buying and selling affects the price. So for example, if I had 1,000 of USDC coin and 1,000 ETH, multiply those together, that's 1 million. The constant K would equal 1 million. Now, for the constant K to continue to equal 1 million, after I purchase some of coin A and I spend some of coin B, well, K still needs to be constant. So let's say I'm putting in 50 USDC. Okay, I'm adding 50 USDC to the liquidity pool. That means I'm taking out some Ethereum, some proportional amount of Ethereum. So if I'm adding 50, this is the delta B, okay? This is how I'm changing the reserves. Well, if there was 1,000 coins over here, now there's 1,050 coins because I added some USDC coin. I'm getting some ETH out of that pool. I'm taking some ETH out of that pool. So I'm subtracting a delta of A. I'm subtracting a little bit of ETH. And whatever amount of ETH I get back, this is basically the variable to solve for. Because we know K is constant from the before I made the transaction. K is constant from the state that it was in before I swapped. And I know how much dollar value I want to spend, how much dollar value I want to add to the reserves of side B. So now we can solve for delta A with simple algebra. Delta A is going to be the amount of coins that I can pull out, the amount of ETH I can pull out. So let's make this really easy. Let's make this really easy before we do an actual example. So if there's 4 of coin A and 4 of coin B, all right, 4 times 4, everyone knows is 16. Okay, K equals 16 here. If there's only 4 tokens of each side, then 1A equals 1B. Coin A, the price of coin A equals the price of coin B. But now what happens if I want to add 4x? If I want to multiply coin B times 4x, if I want to spend 4 times the amount of money that's on the side of coin B, okay, so there's 4 here. If I'm basically adding 12 more for a total of 16, right? That means I'm taking away 3 coin A's. So I have to add 12 coin B's to take away 3 coin A's in order for K to still be 16. Remember, K has to remain constant. So 4 times 4 is 16. 1 times 16 is 16. But that's what's happening here. If I want to withdraw coin A's, I want to get me some coin A's, I have to put in some coin B's. So if I 4x multiply the coin B side, I reduce the coin A side by 1/4, an inverse. So I 4x the coin B side, I 1/4'd the coin A side. But now look at the new price. What is the new price of the coin? It used to be 1 coin A equals 1 coin B. Now, 1 coin A equals 16 coin B. So this is what we mean when we say if you 4x the buy side, you 16x the price. The price functions as a square of how much bid side liquidity you put in there. Bid side is typically referring to either the base layer 1 asset like ETH or Pulse, or typically it's also just dollars. So let's say coin B is dollars and coin A is Pulse. Okay. If I quadrupled the amount of dollars that I put in the pool, there were $4 in the pool, now there's $16 in the pool. Well, one Pulse used to equal $1, but now that I took out all the Pulse by adding all my USDC, one Pulse now equals $16. So again, it functions as a square. If I doubled the liquidity on coin B, I would 4x the price. Because I quadrupled the side of coin B, I 16x'd the price. If I 10x'd the supply of coin B in the liquidity pool, I would 100x the price. So it functions as a square. I don't know how much more easy I can make it, but this visual should give you a basic understanding of how everything works. Now, there's also fees, okay, so it's not quite that simple. I mean, I know some nerd is going to chime in and say, well, actually, like, well, it doesn't matter, okay? This is not for you, smart, nerdy guy. Like, this is for most people that just don't understand, because some people still don't know. They don't know how the black box works. And it's okay if you don't know, but, like, the information is out there. I'm giving it away. Like, some people, when they swap, they don't really understand that, okay, where is this liquidity coming from? It's coming from liquidity pool. How does the price change? Well, the price changes like I just showed you. And there's little nuances too, like what about the trading fees? So technically, the equation looks more like the state that the reserves are in before, reserves of A times reserves of B equals K, and the state afterwards equals reserves of A minus delta A times reserves B plus delta B times a gamma coefficient. The gamma coefficient is just representative of the fee that you pay to liquidity providers. You have to pay a fee. I'm making it negligible for the example, but if I want to trade one coin for another, I'm paying a 0.3% fee. Actually, on PulseChain, it's 0.29%. It's pretty much always 0.3% or 0.29, around that area for most chains, for most pairs. Sometimes you have 1%. Sometimes you have 0.01%. But typically the fees are 0.3%. Now, fees incentivize liquidity providers because that's part of the reward that you get for being a liquidity provider. If you make trading fees for the risk of impermanent loss, the risk that you're left holding the bag of something that's not going up and you're giving away all your other coin that is going up. That's the risk of impermanent loss. The risk of impermanent loss is made up for by fees a little bit, but sometimes people offer LP reward tokens such as INC token, Cake token over on PancakeSwap. Sometimes there's temporary liquidity providing rewards tokens to offset impermanent loss to compensate people for taking the risk of providing the liquidity for everyone to have a healthy market. Now we're going to do some math. Okay, we're going to do some math. X times Y equals K. This is the ultimate equation. And this is interesting because I did this math on a video maybe a year ago, and the conditions were a lot different. Look at the conditions a year ago. There was like $12 million on the buy side, and there was 840 million hex in the liquidity pools. Now, this was a rough estimation. In today's numbers, there's a little bit less. Okay, there's about $2 million and 350 million hex. Where am I getting these numbers from? Well, I'm just ballparking it. Okay, so again, don't get all specific. Let's go over to dexscreener.com. We'll search for hex, my favorite token, and we just want to look for some of the top liquidity pairs. Remember how if I see 1 million in this liquidity pool, well, because it's symmetric, half of that liquidity is on the hex side and half of it is in the form of Pulse. So I'm dividing all these numbers by 2 to get the numbers on either side. Okay, so you've got about, let's say 1.8 million. That's maybe $900 million of hex, plus $500,000 of hex, plus $100,000 of hex. That's maybe 1.5 million, right? And then you've got a bunch of pairs down here, some USD pairs which do matter more. And then you've got some like coins paired to, other meme coins like Hex to SolidX. I'm not going to count some of these other coins like Hex and Sparta, Hex and Helgo, Hex and SolidX. If you pair one coin to a meme coin, the deeper you get with that meta, the less it actually moves the price. Because if somebody is buying in with their dollars, they don't have to route through SolidX to get Hex. They most of the time are just going to be routing through Pulse. So yes, Pulse is getting pushed up on the way because the real USDC pairs are tied to PLS. But if someone wanted to buy Hex, the primary route would be through maybe these top 1, 2, 3, 4, 5 liquidity pairs. So let's call it roughly $2 million of Hex, and then $2 million of Pulse on the other side. So if we want to get specific with that, there's roughly $2 million on, let's call it the buy side, and 350 million Hex on the sell side in terms of the quantity of coins. For example, let's just take this pair over here. Let's go take a look on the side panel on DEX Screener. This is where you can get all that good liquidity data right over here. So we can see they're pooled together. There's 37 billion Pulse tokens worth about $900,000. And there's 183 million Hex tokens worth about $900,000. Remember, we only think in dollars because our brains like it, but really all of the prices on here are ratios of one coin to another. So the only reason we're able to derive the US dollar price is because Hex is tied to Pulse, and Pulse has a lot of liquidity in dollars. So we have to derive it, you know what I mean? You can say that one Hex is worth, what, like 200 Pulse, 203 Pulse? But what means more, what matters more to you, is how much is it in dollars. And so you'll notice that DEX Screener does this for you. Every time DEX Screener shows you a price, it'll show you the actual ratio price right next to it. And it'll derive the USD price for you. So anyway, I'm adding up the basic amounts of tokens. There's 183 million Hex coins in this pair. And in this other pair over here, there's 110 million. So what's 180 plus 110? That's 290. And just adding up, rounding, okay, the Hex from all the other pairs. Let's take it from 290 million to 350 million. So there's maybe 350 million Hex for sale against assets that are liquid with USD. And we're just rounding. I know some guys are going to be like, these are not exact numbers. I'm not saying they are. I'm trying to explain the concept, so pay attention. 350 million Hex is for sale in, you know, this pair, plus maybe this pair, and this pair, and this pair. Roughly. Super rough. And on the buy side, we call it, there's about $2 million. Again, very roughly. And it just makes the math easy to do in your head, okay? So, because X times Y equals K, let's just say we've got $2 million as X, 350 million Hex as Y. That means K equals 700 million. So 2M times 350M. This should be like 700M squared. Now, let's say I want to make the total buy-side liquidity 200 million. 200 million is a fifth of a billion. Not actually that much money. There's trillions of dollars in crypto. A couple. There's like $2 or $3 trillion in crypto. So 0.2 billion is not that much money. And if I wanted to get the total buy side to 200 million, I'd have to add 198 million to get this to equal 200. Okay. So if I'm adding or buying $200 million worth of the token, imagine I did this in one single click. Okay. Obviously it's not going to happen, but in one single click, $200 million comes in, and K still has to equal 700 million squared. So 700 million squared divided by 200 million equals 7 over 2 equals 3.5 million. Okay, 3.5 million Hex. The really simple algebra, if we solve for Y, is that Y equals 3.5 million Hex. All right. I hope you're following along. It really just is algebra. Don't be scared by this. If you want a deep understanding, it's just algebra. And then once this thing clicks for you, you're going to be able to get all the subsequent concepts of how pumpable everything is. It's going to maybe help you sleep at night. Or maybe you won't be tricked into like FUD or something like that. So now we've got Y equals 3.5 million Hex. And remember, the price of one coin is just X divided by Y. So X times Y equals K, but X over Y equals the price. And I got it in dollars already. I pre-converted it to dollars for you because I know you like dollars. This 200 million is made up of, you know, a little bit of Pulse, a little bit of PulseX, a little bit of DAI, a little bit of USDC. I'm just pretending that it's all $2 million, okay? Pretending. Now that's $200 million because we injected so much capital into the liquidity pools to buy Hex in this theoretical example. So $200 million would be X, and Y would be 3.5 million hex. So X divided by Y equals the US dollar price. 200 million divided by 3.5 million equals 57.14. And yes, that's an actual theoretical number. $57.14 per hex. This would be a very successful scenario for hex, but just think about, is it reasonable to assume that we can achieve 198 million of net inflows despite people selling along the way? Well, Solana got to $8 billion in liquidity. You know, a lot of coins are in the billions of dollars in liquidity. So a fifth of 1 billion might be possible. And remember, if it was only 1/10 this good, we could still easily see a hex being over $1. But this would be the theoretical math for about $200 million inflowing into PulseChain, inflowing into hex specifically, to achieve a $57.14 hex. Now remember, it's a square, so the less money I put in, the less outrageously high the price is going to be, and the more I put in, the more exponentially higher the future predictable price would be. So I hope you understand that from a bird's eye view. If we go into PulseX, remember, it's one thing to be a normal swapper. This is what most people do. And if you don't care about the liquidity stuff, you don't have to be a liquidity provider. In fact, a lot of people should not. A lot of people shouldn't do it. But I just want to explain where people do it if they want to. They go over here, they go down to liquidity, they click this. You're probably going to want to use V2 liquidity these days because you're earning trading fees over here, whereas on V1 you're only earning INC token. The trading fees these days are outpacing the INC token rewards. So to me, it doesn't even make sense, right? Even on the stablecoin pairs, like, okay, you can make 10% INC rewards on Pulse USDC, but you can make 40% APY on Pulse USDC over here on V2. And you can use that extra money and go buy INC token, right? If you really wanted to. So to me, V2 just makes sense these days. You could also lock stablecoins. And you pick any coin with any coin, you pair it. You pair it in a 1-for-1 ratio. So if I put up, 1 ETH, it's almost 1 ETH per 100 million PLS. Actually a pretty close ratio there. And now look at what's happened. Look at the change in Hex liquidity. I'm using Hex as an example because it's my favorite coin. This is Hex on PulseX V1. Remember the place with INC token rewards. Look at what happened ever since December of last year. We've seen liquidity have a steep drop off, primarily due to the lack of liquidity provider incentive coin rewards. We went from 10 million liquidity over here down to about 1 million today. 1 million in liquidity today. But what about V2, right? If you're asking what about V2, good job. What about V2? Well, now that more people are migrating from V1 into V2 on Hex, the Hex liquidity spiked from about 1 million to maybe about 4 million. So 4 million plus 1 million, that's about 5 million. But again, we have to divide that by 2 because they're taking in both the buy side and the sell side. If you want to break it up into the equation, we divide it by 2. So what's 5 divided by 2? It's 2.5. And if it's 2.5, well, then why did I use 2 over here? Well, because if I scroll down to the actual liquidity pools, well, a couple of these pools matter more for the price than others, right? Like Hex USDC matters more than, let's say, Hex and Helgo. I mean, Helgo's all these coins are interesting, right? Helgo, Sparta, a lot of other coins that have liquidity pairs. But you'll see here that after you add up like the Pulse Hex, the USDC Hex, maybe a couple of the other big ones, I'm basically subtracting a small bit of liquidity to account for all the meme coins tied to Hex. And there's also a couple of like sell walls, like V3 sell walls over on different exchanges on PulseChain. Like, I don't count those either, even though that does make it harder to move up, but they are kind of negligible. So maybe you do want to make this number a little, maybe you want to make it 3 million instead of 2 million. Because there are some sell walls over here. Like if we look on dexscreener.com, like you see this little bit of liquidity. It's not that much. You see, 272 of liquidity. Great. Let's dig into that. Oh, everyone just had a massive sell wall. It's not that massive compared to the rest of it. It really just matters how big is this number compared to the rest of the liquidity. There's maybe 2 million liquidity on buy side. And this is just an extra, like adding on like an extra 1/10, 264K on the sell side, in addition to all the Pulse and stable coins, which already make up maybe 2 million, 2.5 million. That's not going to hurt us too much, but we don't really care to count stuff like that where it's way lopsided with most people just trying to exit through a single-sided sell wall. And that's what Uniswap V3 does. So if you want to learn about Uniswap V3, we would go over here, and this lets you set range-bound positions. So range-bound positions mean that, let's say I want to pair ETH with USDC, and I've got a 0.05% fee tier, which means every time someone trades, they're paying a 0.05% fee. That fee gets divvied up to all the liquidity providers. We click continue, and here we can set a custom range, and we could say, I only want my liquidity position to be active when the price is within a certain range. Now, I like to switch and toggle to this price so we can actually see the USDC price of Ethereum. Right now, ETH is at, what, $2,400? Let's say I want to make sure my liquidity range only gets activated when the price goes lower. So let's say I want to deploy a bunch of USDC on a single-sided liquidity pool, and I want to put $10,000 of USDC up in this range right below the current price, so that if the price dips into my range, all of a sudden I'm kind of like dollar cost averaging buying up Ethereum as the price dips into this range. Or I could put it on the other side. Notice that if I encompass the current price, I now have two different coins to put up. But notice if I take the lower range and I bring it above the current price, now I've only got Ethereum. So if I wanted to put up 100 Ethereum, this would be like basically putting a sell order between 2,400 and 2,700, saying I want my liquidity to be active when the price goes within this range. And once it's at the other side of the range, once it's come out on the other side, like I think Ethereum is going to, let's say Ethereum goes to $3,000, well then I would be fully in USDC and I would have exited all my ETH because all the traders would have given me their USDC and I would have given them all my ETH because my range would be active over here. So this is how you can kind of sell. So this is kind of how you can buy or sell coins if you think they're going to go up or down over the long run, but you just have to manage this position and pull it out once it's achieved what you wanted to achieve. So if you wanted to use Uniswap V3 like a sell order, like I said, if you put 100 ETH in the range of 2,400 to 2,700, now Ethereum goes up past 2,700, you now have to go manually pull out your order to take all the stable coins that you now have, plus the trading fees, plus any incentive rewards, and you take that out unless you want to leave it in the market and just, for some reason, capture anytime it goes back in the range. You could set the range really wide if you just want to cover more of the price action. And remember, if we go full range is basically no different than Uniswap V2. Full range means if I put up $10,000 on one side, I put up $10,000 on the other side. See? Look how it automatically does that for me. So custom ranges can be used in kind of interesting ways. They can be used to accumulate on the way down. They can be used to sell a coin you like on the way up. We've got places like app.9inch.io, 9mm.io. All these other alternatives on the PulseChain network allow you to do these kind of tricks, but for the most part, most people watching probably don't care and probably shouldn't be doing it either, because if you don't know what you're doing, you're going to lose a lot of money. Even simple symmetric liquidity providing, if you don't know what you're doing, you are going to lose money through impermanent loss, and you're not going to understand what that means. So if you want to play around with $10 or $100, I totally understand that. If you really just want to see how it works. But the reason I'm telling you, mostly, the reason I'm explaining it to you, is I want you to understand how you can mathematically calculate and get some more assurance about how relatively little money it takes coming in. So when retail floods back, when we get another retail FOMO buying, you could have ridiculously high prices of all these coins because the liquidity is so low. I mean, just look at, this is my example from a couple months ago that I went over. There was $12 million on the buy side and 840 million hex. Now, there's only 350 million hex, so maybe half as much hex for sale, but only 1/6 as much dollars on the buy side. So the buy side liquidity has been drastically going down as well. Look at this chart. The buy side liquidity, the total liquidity has been going down. Sure, 1 million over here, 4 million over here for a total of 5 million. But back in December, we had 13 million. And 5 million over here, we had like $20 million. So to go from 20 million down to 5 million, and if you remember to divide that in half, right, it's like 2.5 million. It's really, really low liquidity, is what I'm saying. Really low liquidity. PulseChain is an undervalued, underpriced, pumpable chain And a lot of this has to do with the fact that all the liquidity is concentrated on a symmetric DEX that's more predictable, easier to pump. And you don't have dark alternative pools. You don't have massive sell walls on all these other V3 exchanges. You don't have a whole bunch of centralized exchanges or OTC deals or VC unlocks that are just all these negative externalities of sell pressure that you don't really know where they're coming from, but you know they're out there. You don't have that scenario with PulseChain. It's a much more transparent market. If you want to sell something, well, right now, most of the liquidity is on chain, so people are going to notice you selling something, which we do. We're highly affected by sells, but we're also highly affected by buys because there's not a whole lot of trading going on things like OTC, centralized exchanges, derivatives, or V3. It's just what you see is what you get on PulseChain. Very transparent, all the volume's on chain, all the liquidity's on chain, and that makes you able to guess better potential outcomes. When all the liquidity is on chain, you could see just how much money it would take to really move the prices in a life-changing direction. So if you found this valuable, like, subscribe, share, and leave a comment. And if you want to learn more, check out hexpassiveincome.com. I've got a course that teaches you everything. Everything about liquidity providing is in there, and even more details, even more links, more how-tos, tutorials about actually LPing, doing it as a strategy, impermanent loss, how to make money with all that. If you're interested in going deeper, and if you're a beginner to crypto, all the terminology is in there, everything I've learned, security, mindset, strategies, how to buy, how to sell, all this stuff is in hexpassiveincome.com. Click on that link in the description below if you want to learn more. Highly recommend it. I mean, it's got tons of good reviews. I wish I had something like that too. If I could save you from making all the mistakes I made and losing all the money that I lost, it's definitely worth it in terms of bang for your buck. A one-time fee with a 25% off coupon right now. Check it out if you want to learn more. So I hope you found this somewhat educational. I will see you on the next video.